welcome back to the YouTube channel. In this video today, I'm going to break down Dave Ramsey's YouTube video called Real Estate versus Stocks, which one will make you more money? And for those of you who don't know, Dave Ramsey is a businessman, he's an author, he has the famous Dave Ramsey Show, which is on the radio. It's also streamed live on YouTube as well. He has almost 2 million subscribers. So I think there's some good takeaways in this video that you guys can learn. And I'm just going to kind of give my own opinion on, what he says about real estate versus stocks. So that's coming up right after this. Welcome back to the YouTube channel. If this is your first time tuning into my YouTube channel, I want to welcome you. If you've already been to the YouTube channel, welcome back. For those first timers, I talk all about investing, real estate investing, money management, anything to do with finance. So if that interests you, hit that subscribe button down there. And also for the YouTube algorithm, it's really, really important to make these videos get viewed more. Smash that thumbs up button on this video as well. Now onto the video. Jump behind my computer right now and give my first opinion on investing into stocks or real estate. Dave is talking to someone on a phone call. So let's look at it right now.
Particular certificate of stock.
Well, or if you buy dividend-paying stock, which I don't buy single stocks anyway, but we can discuss the philosophy or the concepts behind it. Generally speaking, you would make a lot, if you do a good job with it, you would make a lot more rate of return on real estate. But it involves more hassle, more of your time. Even if you hire a management company or whatever, you've still got more time than just buying a mutual fund and throwing it in the drawer and forget it. But a buy and hold strategy on real estate, while it generates cash flow, it should outperform stocks, but it has more hassle. It outperforms mainly because it's an imperfect market.
Break down this first part that Dave goes into. First off, real estate versus stocks. He's saying real estate should outperform stocks in a hold situation. Also, what he's saying is he doesn't buy individual stocks, he just buys mutual funds, which for 90% of people I would recommend. I recommend on this channel too. Most people, they just don't have enough experience in the stock market to be able to evaluate a company, look at their balance sheet, everything that's involved with going into picking stocks. So for 90% of the people, it's the easiest just to go out, buy a mutual fund, buy a high cap mutual fund, highly diversified. Simply just put your money in it and forget about it. In 5, 10, 15, 20 years, see what balance you have in the account, and it's going to be more than what you put in at the very beginning. Let's continue the video now. He's going to talk about an imperfect and a perfect market, and I think there's some good takeaways that you guys can learn from this. So here we go.
Term you may be familiar with. A perfect market is one where all buyers and sellers have exactly the same information and the exact same access to buy. And so the stock market is closer to a perfect market than real estate. Real estate, each item is unique. It's unique to a certain area, and all buyers and sellers never have even close to the same amount of information or belief about a piece of real estate. And so real estate gives you a lot more opportunity to get a bargain, in other words, and if you're willing to invest the time, you should make more on it.
Okay, so let's break this down. I actually really like this portion, an imperfect versus a perfect market. So essentially a perfect market, everyone has, the knowledge like stocks, right? Everyone can look into the company. What are they going to do? Should I invest or should I not? Now, this is why I really like real estate. And Dave touches on it right here, the imperfect market. Essentially, when you're looking at real estate, it's way easier to get a bargain in real estate than stocks, right? Because stocks, for example, like 3 months ago when the market was extremely undervalued, in perspective, undervalued, people started buying into the stock market. People that have never even stock traded in their lives are like, wow, I have an opportunity here. Let's start deploying some, money that maybe I had on the sideline. Or whatever. Even real estate investors that had, cash on the sideline waiting for real estate prices to collapse, which they never did, they started deploying money into stocks. So what he's saying with the imperfect market is that with real estate, every single product, every single house is different, right? It's different. Even a new construction residential plat, it's different. Like the house I'm living in right now, there's 15 lots in this plat. Although, 7 of them are the exact same floor plan that I'm living in, they're still different. And how are they different? Well, the driveways are a little bit different, the front yard, the lot configuration, the lot size. So that goes back to, the imperfect market in real estate, that every single product, every single house is a little bit different. And what that means is that each buyer and seller is going to have a different view in their mind of what they think it's worth. So it's a lot easier in real estate to get a good price on a house and to get a bargain. And then when you make those bargains and you purchase a property at the right price, there can be extreme upsides to that. So let's continue on to the video right here.
It's 3 types of return. One is, as you said, increase in value, and cash flow is 2, which is the rental income on it. And 3 is you get to depreciate it. So you actually get a tax break that covers a portion or all of your rent that comes in, and that actually has a cash value to it. So when you put those 3 together, that's called an internal rate of return. Have you ever heard that?
Yes.
Okay. So an IRR on a piece of real estate that is under $1 million, a small apartment, a small a basic home, a small office or something like that, your IRRs ought to be north of 15%. Mine are on almost everything I own that's income producing. And your cash on cash in most cases with a typical piece of real investment property would be 8 to 12%, somewhere in there. Your cash on cash alone would be.
Let me touch on that cash to cash portion really quick. When you're looking at investment properties, obviously you want to know what return you're getting on your money, right? And I touched on this in a previous video. I'll link it up above there somewhere. And essentially when you're calculating this return, most people are going to leverage a deal. Most people don't have 100% cash to buy a deal. And actually coming up here in a few weeks, I'm going to make a video on how you can actually buy your first investment property with 0 money down. But that's going to be for a future date. But essentially what it means is you're going to leverage the deal, right? If you're buying a $500,000 investment property, you're probably going to put 20% down, $100,000 down, take out a $400,000 loan, right? So your cash on cash is what part of that do you have skin in the game, right? $100,000, skin in the game. How much rental income are you getting a month? You multiply that by 12, you get your net operating income, and essentially you're gonna, divide that by your cash that's in the game to get your cash on cash return rate. So that's kind of how that is. Most deals are going to be leveraged, especially with how low interest rates are right now. So let's continue on with the video.
Now, again, on stocks, you got 2 possible places of return. One is the increase in value, and 2 is the 2 is possible dividend payouts, which are profits shared with the owners of the company. And when you're a stockholder, you're an owner of the company, so you could get dividend payout stocks, and you'd have a cash flow with that kind of a thing, and you'd have the increases in value. So in both markets, though, people make the statements that you were making, that it's artificially high, or it's ridiculous, or there's a bubble, or there's no way that supports that, when in reality, there's a few times that that's the case. We had a tech bubble in 1999, the dot-com rage, where people were buying stocks on companies that had never made a profit. So that was ridiculous, obviously, and they shot through the roof. Most of those didn't survive. A few name brands that are household names did survive, like, for instance, Amazon. But by and large, the stock market overall is never overpriced.
I mean, in some instances.
In what way? In what way?
Well, it's similar to the example to ExxonMobil. I haven't checked what their dividend pays, but the stock was artificially undervalued. But if at the time, whenever it was supposedly correctly valued, if I purchased shares of ExxonMobil, I don't get.
Essentially what's happening here is reacting to the person he's talking to on the phone, saying the stock market is like gambling. I'll tell you right away, this guy is just not experienced in stock trading, the guy that he's talking to, because the stock market is the farthest away from gambling, because you have all the information in front of you, right? How much is the company making? What is their growth? You have all the analytics, all the data on every single public traded company. So I feel like that's the farthest away from gambling. Gambling is putting your money on a table and crossing your fingers and hoping that you roll a 2, you roll a 5. With stock trading, you have all the data in front of you, right? So you can see, right? If you think the company is going to grow every single year, you can see the numbers, right? What's going to be their marketplace that they're competing in, right? So with all that analytics, all that data, you can make reasonable bets on companies and buy shares, and it's going to appreciate through the years with a long-term outlook. So let's continue on with the video.
A portion of their earnings, with the exception of the amount of dividends that they pay.
Agree.
The only way that
you are betting that Apple, McDonald's, Coca-Cola, Home Depot are going to be worth more 5 years from now than they are today. And why would you make that bet? Well, you would look at their track record of growth, the stock price growth, and you would look at the management team, and you would look at the profit.
Yeah. Give some of the takeaways on this video. Stocks versus real estate. First off, stocks is just easier to enter, right? You don't need as much money. You could simply buy a stock for, if you had a couple pennies, a couple dollars, you could buy a share of a stock. Now for real estate, you're going to need a significant amount more money. For a non-owner occupied residence, you're going to need 20% down, 25% down for the best interest rate on an investment property. We're talking about a $500,000 purchase. That's $100,000 you're going to need. And then not only that, you're going to have to qualify for the monthly mortgage. And it's just a lot more hassle that goes into buying real estate. But with real estate, like Dave touched on, you get that asset, you get cash flow, you get to depreciate it. And then also you get the appreciation every single year. You're building equity, and you have a solid, tangible asset that you can go out, you can drive to, you can touch, you can feel, and it's not going anywhere, right? Unless a hurricane comes through or something crazy comes through, that house is going to be sitting there for you when you turn 60 or 70. And you want to retire and you sell it. Right now with stock, obviously it's a lot less hassle. I could go on my computer right now and I could buy a stock in 2 minutes, and 30 minutes later I could click sell. So it's highly liquid. Real estate isn't as liquid as a stock, meaning that you have to, obviously you got to hire a real estate agent like myself. You got to list the property. Maybe it sits on the market for 30 days and then you have a 30-day escrow. So in terms of being liquid, stock is way better, right? I could go and sell my whole portfolio right now and transfer all the money into my bank and have it there in 3 hours. With real estate, you're probably looking at waiting at least 45, 60, 90 days to get your money out of the deal. Now, this is my advice to you. I think you should be diversified in both, okay? I think that there's a lot of money to be made in the stock market. There's also a lot of money to be made in real estate. It's a very opinionated topic, but why not just do both and be diversified in both? When it comes in terms of stock, right, I would say, like I already touched on, for 90% of the people, just invest in a high cap mutual fund like VFIAX, that's a Vanguard mutual fund, or VTI. It's a total market index. It's going to leave you highly diversified. It's simply just type in the ticker symbol. Some of them have minimal deposits of $2,000, $2,500. Simply just buy that every single year. Put 10% of your gross income, whatever that amount is, whatever you make per year, and just buy that market index. You could buy it in an individual account. Ideally, I would like to see you buy it in a Roth IRA. So you're deferring that tax. And if you do buy other stocks, buy and sell just kind of for fun. You're not going to trigger short-term or long-term capital gains. I made another video about this as well. That's a really important part of it, because what a lot of people don't realize is You pay tax when you buy and sell a stock, short-term or long-term capital gains. It's a little bit different of a tax liability when you hold the stock less for a year or more than a year. Ultimately, if you're young out there watching this, you haven't even started investing at all, maybe you don't even have a lot of money or whatever the case might be, you're gonna learn what you like just by experience alone, right? You're gonna have failure, you're gonna lose money, but just remember, it's just a learning experience. And 5 years, 6 years down the road, you're gonna know, what rate of return you could get on real estate, like the average rate of return. What average rate of return are you getting on your stock portfolio account every single year, so you can kind of weigh it out. How do you want to allocate your money? Do you want to start looking for more real estate? Do you want to start investing more in stocks? It's a very opinionated topic, but I think being diversified in both is really, really important, not only for retirement, but just for having cash flow and that passive income lifestyle. So hopefully you guys like this video. Stay tuned for next week's video and have a great week, guys. We'll see you.